Before we dive in, welcome back to Gold Rush Reporter, the place where we cut through the noise and talk about what's really happening with gold, silver, and the markets that move them. I'm your silver analyst, and today we're looking at something that's leaving a lot of people scratching their heads. Gold is being dumped by the public, yet the price keeps going up. Sounds strange, right? Usually, when the average investor sells, prices drop. But not this time. So, what's really going on here? Who's buying all that gold while the public is selling it off? Let's dig in. See, when gold prices rise even as people are selling, it means someone else, someone much bigger, is stepping in to buy. We're not talking about small investors or jewelry buyers here. We're talking about institutions with deep pockets and long-term strategies. And the biggest players in this game right now are central banks. Over the past few years, central banks around the world have been quietly accumulating gold, and they've accelerated that trend lately. This isn't speculation, this is preparation. When the public is focused on short-term profits, these central banks are thinking about long-term survival. They are not buying gold because they expect a quick spike. They're buying it because they see what's coming. A weakening dollar, rising debt, and instability across global markets. Now here's the interesting part. If you look at who's leading the charge, it's mostly foreign central banks. Countries that no longer want to depend on the US dollar. They see that the American fiscal position is getting weaker every year, and they're diversifying their reserves. Instead of holding as many US Treasury bonds, they're converting that paper into something real. Gold. That's why, even when the public sells, gold doesn't crash. The real demand is coming from entities that don't sell on emotion. This tells us a lot about how the financial landscape is shifting. The big money knows that fiat currencies are losing credibility. Inflation may not always be visible day to day, but over time, the value of paper money erodes, and those holding it are slowly losing purchasing power. Gold, on the other hand, doesn't rely on a central bank's promise. It simply exists, it holds value, and it's recognized everywhere. The disconnect we're seeing now between retail sentiment and institutional behavior is a clear signal. While the general public is getting discouraged by the short-term price swings, central banks are positioning themselves for the next decade. And when that kind of money moves, it doesn't just change prices, it reshapes the entire market. So the real question becomes, what does this mean for silver? Because while gold is leading the charge, silver has been lagging behind. But historically, that gap doesn't last forever. When gold moves, silver eventually follows. And it moves faster. In the next part, we'll take a closer look at how silver fits into this global picture, why its price hasn't yet caught up, and what signs might tell us that a massive silver run is just around the corner. Silver's current position in the market is one of quiet tension. While gold has been grabbing all the attention because of central bank purchases and its role as a reserve asset, silver has been sitting in the background, waiting, building pressure. On the surface, its price seems stagnant compared to gold. But when you start looking deeper, you realize silver's story is setting up for something far bigger. Silver operates in a dual world, part monetary, part industrial. That's what makes it unique and also incredibly powerful when market conditions align. On one hand, it shares gold's history as a form of money, a tangible store of value recognized for thousands of years. On the other hand, it's an industrial metal that powers modern life. Everything from solar panels, electric vehicles, and smartphones to medical technology depends on silver. In short, our technological future runs on this metal, and yet The market keeps pricing it as though it were just another commodity. Now, let's talk about the imbalance between supply and demand. Every year, industries consume more silver than the mining sector can produce. And a lot of that silver, once used in electronics or solar panels, is never recovered. It's not like gold, which is hoarded and recycled. Silver gets used up. This means that, over time, the above-ground supply is shrinking, even as new demand sources are growing. This hidden deficit is slowly tightening the market, and when the pressure finally breaks, prices can move in ways that catch everyone off guard. What's interesting is that while industrial demand keeps climbing, investment demand is still relatively low. Most retail investors are distracted by trends, crypto, tech stocks, or short-term trades. They've forgotten what silver represents, real value that stands outside the financial system. But those who remember, or who quietly accumulate during these quiet times, are setting themselves up for what could be the biggest move of the decade. If you think back to past silver bull runs, you'll notice they often start slow, then explode. It's a pattern of disbelief turning into a rush of excitement. At first, silver lags behind gold as investors focus on safety. But when gold breaks key resistance levels and the world begins to fear inflation or currency weakness, silver becomes the more exciting play. It's smaller, more volatile, and more affordable. So once sentiment shifts, it doesn't take much to send it soaring. And right now, the conditions are starting to look eerily familiar. Inflation is still a global problem. Debt levels are skyrocketing, and confidence in central banks is slipping. Meanwhile, the energy transition is accelerating, and with it, demand for solar and electric technologies. These industries don't just need silver, they depend on it. That means, unlike speculative demand, industrial demand is locked in. It's not optional. The key takeaway here is that silver's underperformance isn't a sign of weakness. It's a sign of opportunity. The metal is quietly coiling while the rest of the market sleeps. And just like every previous cycle, once the awareness catches up, silver tends to move fast and far beyond expectations. In the next part, we'll go deeper into the macro picture. Who's really controlling this market? What role big institutions play? And how manipulation in the paper silver market might be hiding the true strength of physical silver's demand. When we start peeling back the layers of the silver market, things become a lot more revealing than they appear on the surface. On one side, we have an incredible industrial and monetary demand that keeps rising year after year. On the other, we have a pricing system that doesn't reflect that reality, and that's not by accident. Silver's price is being shaped more by paper markets than by physical supply and demand. And that's where things start to get interesting. The majority of silver trading doesn't actually involve real, physical silver changing hands. Instead, it's dominated by futures contracts and derivatives, pieces of paper that represent silver but aren't backed by physical ounces sitting in a vault. This means that the price you see on your screen isn't the true market value. It's a reflection of leveraged bets made by big institutions, traders, and banks. The most influential of these exchanges is the COMEX, where enormous volumes of paper silver are traded daily, often far exceeding the amount of real silver available in the world. For years, large institutions have been using this system to suppress volatility and, in many cases, keep silver prices from rising too quickly. They do this by opening massive short positions, essentially betting that the price of silver will fall. This tactic helps maintain the illusion that silver is abundant and keeps investors distracted from its real scarcity. But as global demand grows and physical inventories continue to decline, that manipulation becomes harder to sustain. You can already see the cracks forming. COMEX registered inventories, that's the silver available for actual delivery, have been falling sharply. The London Bullion Market Association, LBMA, which holds a huge portion of the world's physical silver, is also showing declining reserves. At the same time, premiums on physical coins and bars remain elevated, which tells you one thing: real silver is harder to find, even while the paper price says otherwise. When those two realities drift too far apart, the market eventually snaps back to the truth. We've seen hints of this before. Back in 2021, the silver squeeze movement exposed how fragile the paper system really is. A coordinated effort by retail investors to buy physical silver forced the market to scramble for supply. Dealers ran out of stock, premiums spiked overnight, and major exchanges had to reassure participants that they still had enough metal to meet demand. It was a small event compared to what could happen if institutional investors, or even a few large industrial buyers, demanded physical delivery on a massive scale. If that day comes, and the physical market finally calls the paper market's bluff, the results could be explosive. The entire pricing structure would have to reset to reflect real-world scarcity. This is what analysts call a potential silver short squeeze, a rapid, uncontrolled surge in price when there's simply not enough metal to cover all the paper promises. And here's the thing: we're closer to that point than most realize. As the global financial system becomes more unstable and nations diversify away from the dollar, the demand for real assets, not paper representations, is only going to increase. That's when silver's dual role becomes unstoppable. A metal needed for industry and a form of money for those losing faith in fiat. So while the public remains focused on the surface, short-term price moves and daily headlines, the smart money is watching what's happening underneath. They know that when a market this tightly controlled begins to unwind, it doesn't do so gradually. It snaps. In the next part, we'll explore what that snap could look like, the triggers that could cause the silver market to break free, the potential scale of the price reaction, and what that means for those holding physical silver when the reset finally begins. If the silver market were to break free from the paper control system, the effects would be profound, not just for silver investors, but for the global financial system as a whole. Let's take a closer look at how that scenario could unfold and what key events might trigger it. One of the biggest catalysts could be a breakdown in trust within the paper markets themselves. Imagine a situation where too many traders suddenly demand physical delivery of their contracts, more than what COMEX or the LBMA actually have available. This would expose the leverage problem at the heart of the system. Remember, there are dozens, sometimes even hundreds, of paper claims for every single ounce of real silver sitting in vaults. If even a small percentage of those paper holders request delivery, the system could quickly run out of metal. That's when panic sets in. Refineries would be flooded with new orders, dealers would sell out, and premiums on physical silver would skyrocket overnight. The paper price, which is artificially low, would no longer matter because no one would be willing to sell at that rate. Instead, the physical market would start setting its own price based on actual availability. This separation between the paper and physical price is known as decoupling, and it's one of the clearest signs that the manipulation era is ending. Another possible trigger could come from the industrial side. Silver is used in solar panels, electric vehicles, batteries, medical technology, and hundreds of other applications. These industries depend on a steady supply of silver, and they can't wait around for refineries to catch up if shortages hit. If industrial consumers start to face real supply constraints, they may bypass traditional markets altogether and purchase directly from miners, paying whatever it takes to secure the metal. That alone could send prices surging far beyond current levels. There's also the geopolitical factor. As nations continue to move away from the US dollar in international trade, more of them are looking toward tangible assets like gold and silver to stabilize their reserves. Central banks have already been increasing their gold purchases at a record pace. Silver could be next, especially for countries looking for a cheaper alternative that still provides protection against currency devaluation. When all these forces converge, industrial demand, investor demand, and geopolitical shifts, the silver market could experience what analysts call a supply shock. This happens when demand dramatically exceeds available supply, and prices have no choice but to move higher to rebalance the market. We saw similar behavior in other commodities before, such as oil or uranium, where years of underpricing and underinvestment led to sudden, explosive rallies once real shortages appeared. And here's the key: the world is not ready for a true silver shortage. Global mine production has been declining, recycling rates are down, and new discoveries are becoming rarer. Yet demand keeps increasing. That's a recipe for a massive price revaluation once the paper system can no longer hide the imbalance. For silver stackers and long-term investors, this isn't a time for panic, it's a time for preparation. Having physical silver in your possession means you own an asset outside of the financial system, immune to paper defaults or electronic restrictions. When the price reset begins, those holding real metal will be in the strongest position, while those relying on paper promises may find their holdings revalued at zero. In the next and final part, we'll discuss what the post-reset world might look like, how high silver could realistically go, how to position yourself strategically, and what role physical silver will play as the global financial landscape shifts toward hard assets once again. Once the silver market finally breaks free from paper control, we'll witness one of the most significant wealth transfers in modern history. The entire pricing mechanism of silver would shift from digital contracts to physical ownership. And that's when things start to get very real. When the physical market takes the lead, silver's true value, long suppressed by manipulation and leverage, will finally surface. We might see prices that shock even seasoned analysts. Some believe silver could easily reach triple digits once the paper to physical decoupling takes place. That might sound ambitious, but when you consider silver's rarity, its expanding industrial demand, and its historical price ratio to gold, it's not unrealistic. The silver to gold ratio currently sits far above the natural ratio found in the Earth's crust, which suggests that silver is extremely undervalued. As confidence in paper markets erodes, investors will chase real assets, and silver's affordability will make it the obvious choice for the average person looking to preserve wealth. This revaluation won't just affect stackers, it will ripple through the entire financial system. Mining companies will suddenly become much more profitable, refineries will struggle to keep up with demand, and premiums on coins and bars could climb even higher as physical inventory dries up. Governments and financial institutions may even attempt to step in with new regulations or restrictions to slow the rush into tangible assets. But once the truth is out, that real silver is far scarcer than its paper representation, there will be no going back. For stackers and long-term holders, this moment will validate years of patience and discipline. Those who have quietly accumulated ounces over time will finally see the payoff of their strategy. Owning silver isn't just about speculation. It's about sovereignty, holding an asset outside of the financial system, beyond digital control or political interference. It's a statement of independence and foresight. If you're new to stacking, the best thing you can do right now is start small. but stay consistent. Build your position over time. Focus on physical silver that you can hold in your hands and educate yourself on the fundamentals of the market. Avoid emotional decisions based on short-term price movements, because when the reset comes, it will happen fast, and only those who already have silver will benefit from it. The next decade is shaping up to be transformative for precious metals, and silver will play a central role in that change. As economies around the world face inflation, currency debasement, and growing distrust in financial institutions, silver will stand tall as both a store of value and an industrial necessity. So, if you've been wondering whether silver still matters, it absolutely does. The coming years could redefine its place in global finance, and you'll want to be on the right side of that shift. Thanks for watching today's analysis here on Gold Rush Reporter, your trusted source for insights on silver, gold, and the real story behind precious metals. If you found this breakdown helpful, don't forget to hit the like button, subscribe for more updates, and share your thoughts in the comments below. Until next time, this is your silver analyst signing off. Stay smart, stay prepared, and keep stacking.